My guest today is Sean Ward, Senior Managing Director of Blue Owl Capital and member of the firm's Board of Directors and Executive Committee. Blue Owl's GP Stakes vertical accounts for $51.8 billion of the firm's $165 billion in assets under management. With over a decade of experience in this strategy, starting at Dyal Capital, Blue Owl is a leading capital solutions provider. With that, thank you so much, Sean, for joining us here today.
Thank you.
It's good to see you, and let's start in the very beginning. GP Stakes, what is the strategy, what does it do, and why should investors be interested in it?
Well, the good news is my strategy is quite a bit simpler than a lot of the other strategies you probably hear about here. GP Stakes is pretty much exactly what it sounds like. Our business buys minority equity stakes in large alternative asset management firms. And in terms of why investors should be interested in it, I think a lot of folks have seen that the GPs, the managers of private equity strategies, have over the years generated quite a lot of wealth, both for their investors, but also for themselves. And I think a lot of investors have wondered, is there a way that I can get access to the GP's economics? Can I put myself on their side of the table? And really that's what we aim to do with our strategy.
Right, and of course GP Stakes does exactly that. You're investing through a minority interest into some of those GPs. And you mentioned the cash return. And so if I'm an investor in the GP Stakes fund, what kind of cash returns, cash yields can I expect from this?
Well, I mean, of course it varies year to year, but when we underwrite one of these transactions, we want our money back just from those operating profits from management fees, carried interest, and balance sheet returns. And we want a nice multiple of our money back over 10, 11, 12 years. So private equity-like return, but through that annual cash flow yield. So in a really good year, high teens, more like a mid-teens is our base case. That's the type of cash flow we're trying to generate.
Right. And I'm curious, how is today's market environment impacting this mid-teens yield expectation? Are you looking for opportunities that push you higher into the teens, or because of maybe lack of exits that some of the private equity firms are realizing, maybe that yield skews a little bit lower?
We've been very lucky, and it's important to also just make clear that when I say private equity, I'm speaking very, very loosely. I'm really speaking about anything in private markets that's in a closed-end drawdown format. So we buy stakes in buyout firms, but we also buy stakes in real estate, private credit, infrastructure, venture and growth equity firms, et cetera. And so because we have such diversified portfolios, even when things are a little bit slower in one part of the portfolio, like in buyout, broadly speaking right now, other areas like private credit are doing very well. I mean, I'm sure you're probably tired of hearing that it's a golden age for private credit, but that's certainly proven to be true
on this program.
I'm sure, and sorry for adding to that list. We've been very fortunate to be able to continue producing the type of cash yields we were hoping for, even in the current market.
And you mentioned the diversification. So when you think about GP Stakes, it's not just investing in private equity, but it's truly investing across the entire private market universe. And of course, if you look at private markets, the assets under management have grown tremendously, right, to 12 trillion or 13 trillion, and that is set to go to 28 or so in the next few years. So that's a tremendous opportunity to participate. But here's the question. I imagine you work with some smaller GPs and some of the larger GPs, and maybe help me understand where you are, in terms of that market. But also, if I'm a large GP, why would I want to give away a minority interest in my company? And the name that comes to mind, CVC, for example, 188 billion euros in assets under management. Why would somebody like that come to you for your GP stake strategy?
Yeah, and unfortunately, they're not giving it away. We do have to buy it still, but it's a very fair question. And we look at managers of all different sizes, but really in our flagship strategy, we're focused on the upper end of the market. And that's where we've done most of our deals. It's really where we're doing most of the market's deals, in fact. And why a manager would want to do this? Well, when you think about private equity as a business, it consumes a lot of capital. Every time you raise a fund, you have that GP co-investment obligation to invest alongside your investors in the fund. And so when you're talking about a firm like CVC, I mean, their last fund was 26 billion euro, right? They raised it in 6 months last year. If you assume a 2% GP commitment, that's 520 million euro just in that one fund alone across a much broader platform. So you should think about the capital that we're providing as not being a liquidity event for anyone. It's actually balance sheet capital for the firm that's going into investing in funds like CVC's latest fund. It's going toward acquiring businesses to add to a firm's platform. It's going toward helping with succession planning from one generation to the next, et cetera, et cetera, et cetera. It's really the firms that are doing the best that are most in need of that growth equity that we can provide. And we're very fortunate to be in the position to write the biggest checks in the market right now.
How is the current market environment impacting the opportunities that you see for GP stakes? Is it because we've seen a slowdown in fundraising, you're seeing more opportunities and more managers come to you for that additional capital, or what's the impact that you see of today's higher rates, slower fundraising?
Right. I think on average, it's very, very true that fundraising has slowed. I think when you look at the upper end of the market by size, where we're really focused, the slowdown has been much less pronounced. I mean, our managers, by and large, have hit their numbers or exceeded their numbers on the fundraising side. I think even firms, though, that are looking at the market from a position of strength can look around and say, well, it would be very, very helpful to have balance sheet capital, whether it's to launch new products and get them to scale more quickly, or to go out and acquire businesses and add them onto the platform to add different business lines without having to grow them organically. There's a lot of flexibility to play both offense and defense that having a balance sheet provides. And that's really been our bread and butter for a long time. But right now, I would say our capital is in more demand than it ever has been previously.
Right. Well, that's great to hear, and that's great to have that opportunity. Sean, thank you so much. This has been terrific. Thanks so much for joining us today and for a great discussion and sharing your insights today.
Thanks for having us, or me. Thanks for having me.